Meeting is being recorded.
So actions taken to control the coronavirus epidemic, like I said, began to show up in the Chinese economy in mid-January and in markets outside China beginning about a month ago, late February. We want to and have tried to estimate what the impact of all these actions has been on demand, but with the caveat that estimating demand has always been more of an art than a science, even in the best times. On the supply side, you can look at pipeline deliveries, you can look at tanker loadings. While all that's hard to gather, it's still much easier than trying to figure out what 7.5 billion people are trying to do each day in terms of oil consumption. So the demand picture is always pretty opaque. The data, if you're familiar with it, comes into us about 6 months really after the fact is when we first begin to get good solid demand numbers, I think. So we're trying to do to estimate things that have just happened over the last 60 days or so, and so that's tough. But as I think about this, the impact of slowing down economies and the impact that has on oil demand, there's really two things to concern yourself with here. I think one is the issue of the depth of the demand destruction that's taking place, and the second part is the duration. How long will we see an impact on oil consumption around the world? And of those two questions, the depth versus the duration question, I think the duration issue is harder to get a handle on and more important. And so we clearly believe that that the impact of the slowdown in demand on the consumption side will be mostly contained to the first half of this year. And I just thought I would talk a little bit about our mental model that we use to think about what's going on.
And John, please let me know when to advance slides.
Yes, I got you. Okay, just a minute. So the mental model, I think, will help us understand the events, the stresses, failures and successes that people are having. And then because I'm talking to an audience full of economists, I thought I'd mention some of the cost-benefit trade-offs we believe we're making as a society. So with that, let's go to the next slide, slide number 2, Amy. Because there, I thought, let's think, we think of that there are basically 4 systems that define our current economic crisis. We have sort of medical, economic, social, and these are controlling these 3 systems, and being controlled by them in turn is the political system. So medical system clearly has had a goal of limiting infections and deaths, but as it stands right now, there are no cures, and the medical system in the US and in most places around the world lacks the resources for treatment. So this has put a lot of pressure on the economic system to produce them. But that's a slow response, and what we're finding out in terms of providing the ventilators and beds and the doctors and the nurses and vaccines and so forth. So the fastest countermeasure that we have is clearly the social one, which is some form of isolation, quarantining, sheltering in place, what my brother Richard is doing, which is barricading in place. And so, what we're finding, of course, is that the best available medical solution creates a massive economic dislocation, the danger of which is the immediate decline in economic activity and potentially, systemic destruction. So the medical system solution has just stunned the economic system, and the political system is trying to stabilize it. All that means to me, or what we think about this, is that social stress and economic stress is unsustainable in its current form. So we're beginning to see a discussion emerge about calculated risk and easing or mitigating some of these isolation questions, going back to work. And so that's why we believe that the hit to the economy here in the US and around the world for the most part will be largely contained to the first half of 2020. And so you'll see that in the estimates of global oil demand that we'll make in just a bit. I've got a little spreadsheet there on the right-hand side of this particular chart, which really is, there's lots of different ways to think about cost benefits. And I've just pulled together some numbers here. And if anybody has some thoughts about what a model like this should look like or how it could be improved, I'd be happy to hear about them. But just in general, you can sort of go down the list and see roughly, in very round numbers, the U.S. economy is roughly at $2 trillion per month. What percent of it is being impacted by the shutdown? I've said let's assume 10% is been reduced, a 10% reduction due to the shutdown. How many months will that last? 2. You do those multiplication, you get about a $400 billion impact on economic hit, as it were, due to these economic measures. What's the value of a life? Well, as it turns out, there's been a fair amount of research done and estimates made. And so you take the value per year of life, and in round numbers, it's close to $125,000 per year of quality, year of a life. If the average person that we might save is close to 70, so I'm assuming another 10 years of life, they might have that says the value of that life saved is a little over $1 million. Again, you do all the math, you say, well, with a $400 billion investment, you save over 300,000 lives. Given what I think is the fatality rate, that basically means we're preventing somewhere over 25 million infections of this disease here in the US by taking the actions that we've taken economically. Now, all these numbers are estimates at this stage, and I'm sure over time we'll be able to do a lot to refine them and improve it. But that's sort of the medical impact, as it were, the actions we've taken and the cost that comes with that. Well, let's go on to the next slide, if you would, Amy. Our slide number 3, how fast and how far will global oil demand fall? We've modeled 2 cases. One we've labeled base, one we've labeled low. The base case assumes that the worst of the shutdown we'll see here in the US will be in the March-April period. And then it will begin to recover, and it'll go back to consumption levels that had been estimated to occur before the virus emerged. So what you see when you average all those numbers out is average consumption on a global basis of 99.7 million barrels a day, and that would be down right at 1 million barrels a day from what it was in 2019. The low case assumes that the hard shutdown period will be March, April, May, and June, and then a recovery. When you pull all those numbers out, you get demand over the course of a full year down 3.5 million barrels a day from what it was last year. So we have, we've just begun to see some numbers emerge looking at what's happened to demand. The EIA produces what do they call it, a petroleum supply weekly, which just came out with numbers for last week, which showed that refinery runs here in the US were down 2 million barrels a day last week from the prior week. So that was sort of the tip of the iceberg, one of the first returns, sort of a hard number that I've seen regarding what's happened to demand. We don't ask the question, or we don't answer the question about what if the virus returns in the fall? What if this is a typical flu-like virus that reappears in the fall? We've not allowed for that in any of these numbers, and clearly that could happen. But we've not allowed for that in these figures. So that's a big caveat that folks should be aware of. But if, in fact, we do get back to previous projections of growth rates, what that would say, interestingly enough, is that in 2021, so next year, global oil consumption would be just shy of 103 million barrels a day. So a pretty substantial pickup year over year. It would be something very similar to what happened to the global oil consumption following the 08-09 financial crisis. Consumption fell very sharply for about a 12-month period and then bounced back very sharply and grew about 3 million barrels a day from, as I recall, 09 to 2010. So it would be that similar kind of a response that we've seen before. The big question, one of the big questions then, is the monetary and fiscal stimulus that we see our government, central banks around the world, other governments all taking. Will those, might those do to spur economic activity, and would low oil prices that we see today encourage greater demand growth than what the projections before were based? The earlier projections were based on oil prices staying in the 50s. What might happen to oil consumption with prices in the 30s? Could those be higher come 2021? Might be a possibility. So it's interesting to think about what happens to demand. I think from an industry standpoint, you have to then turn to what's the effect regarding global oil inventories, and that's my next slide. So if Amy, if you'd advance that, the question we ask ourselves is how fast and how high will global oil inventories rise? And these are crude and refined product inventories. And so again, the two cases, as you've seen before, and I kept the Keller chart the same. So with our base case forecast, we would see global inventories rising a bit over a billion barrels by the fourth quarter of this year, and then beginning to fall and eliminated by the middle part of 2022. So in the base case, again, we're assuming that global oil consumption rises strongly next year, and that helps begin to work off the excess inventories that are coming into the market this year. And of course, with our low case forecast, low referring to both the demand side of things as well as the oil price picture, of course, global oil inventories, the problem becomes even worse, and they peak somewhere around 1.6 billion barrels, again, in the latter part of this year. And I think under that kind of a scenario, the question that comes immediately to mind is, where do you put 1.6 billion more barrels of inventory? I'm not sure globally we have that kind of capacity. So there's some real world issues associated with that. Again, these are inventories, both commercial and strategic petroleum reserve. And for those who might ask, here in the US, we have presumably about 100 million barrels of unused capacity in our strategic petroleum reserve. And of course, the government's made an announcement that it would buy some oil and put it in those reserves, in our SPR. So again, you've got where this oil goes to inventory is a combination of both commercial as well as strategic reserves here in the US and around the world. I should point out again that the tag at the bottom of that page is that, under the low case, that those excess inventory numbers don't get eliminated until the middle part or the first part of 2023. So this demand destruction that we're facing as an industry, given that producers are not pulling back production, means that we'll have a long period of time where we have to deal with excess inventories. And if you look back over time, there's been a pretty good correlation between high inventories and low oil prices, and we think that would continue to be the case going forward. So that gets us into the discussion about where we think oil prices are headed. So Amy, if you would advance this slide 1 to slide 5, where are oil prices going? So again, low case, base case. We, of course, read headlines like everybody does that folks talking about, oil prices in the teens at some point as potential, or my favorite was that oil prices are going negative. I don't see that happening we believe under the base case that oil prices, though, do stay low, and by low we mean well below $40 a barrel throughout this year and next. They gradually began to improve slightly toward the end of next year, but either under our base case or our low case, we're looking at a sub $40 oil price for this year and next. And we only began to get back to a mid-50s kind of a price, back where we were last fall. We only get back to that point once we return to normal inventory levels. So again, remember from the previous slide, the normal inventory is something like mid-2022 in the base case and the early parts of 2023 in the low case. So we've got that then signals a change in the marketplace, because one of the things we would believe that will happen is that U.S. oil production will fall significantly, and I'll talk about on the next slide. But before we get there, we would make is that, boy, we get into after 2021, we just don't see much spare production capacity anywhere in the world. The U.S. production would have fallen. We're assuming that Saudi and Russia and everybody else is pretty much at max production. Exception would probably be Iran, which might yet be under sanction. So there's some oil held off the market there, but basically everybody else is at full production by the end of 2022. And if demand continues to grow from that point, there's a short period of time where you still can run down inventories and they get back to normal, but then right after that, they begin to fall below normal. And again, that's always sent a signal to the marketplace that oil prices need to rise. And so we would see oil prices beginning to take off soon after we get to this balance point from an inventory basis. And if in fact it's prices which have to be the lever to restrict oil demand growth, we know that oil demand is fairly price inelastic. And so it's not out of the question, I think, to imagine that under a situation where inventories are normalized or falling below normal, demand's continuing to grow, that oil prices would have to increase by a factor of 3 or 4 from where they are today in order to factor back or rein in what consumption might, how fast consumption might grow. Now, the other thing about oil prices, I guess we all have to be aware of, is that the next OPEC Plus meeting is in June, and I don't think the group is going to meet ahead of time and make nice or take any decisions. But the June meeting will be an interesting one, because if we're correct, it will be taking place about the time that you see the first significant drops in U.S. oil production beginning to take place. So why don't we go to the next slide, Amy, slide number 6, which is our model of what this all means for U.S. oil output. And as you can see, we're right a little over 13 million barrels a day crude production today. Because we didn't really see a slowdown in drilling activity or frac activity in March, that means that our April production numbers will be pretty much the same. They'll begin to slide starting in May, but come June and July, and certainly after that, I think we'll be in a position where the month-to-month changes could be on the order of minus 250 to 300,000 barrels a day down. So again, a June OPEC meeting will be happening, we think, at a time when oil production from the U.S. is beginning to noticeably fall. It might even be falling ahead of that because one of the things we pick up, we've got a lot of phone calls, as you can imagine, over the past couple of weeks, and folks who are in the well servicing business have told us that their work for repairing, doing rod jobs, tubing testing, and so forth on maintaining old wells have really just come to a stop in the past 7 to 10 days. Operators are looking at their older legacy wells and that have run into some kind of a production problem and saying, I'm not spending any money on that now. And so that's clearly taking a well offline and leaving it offline until prices recover. There are somewhere in the vicinity of 1 point U.S. oil production from a legacy conventional field in the lower 48 is in the range of 1.3 million barrels a day. So about 10% of our total production currently comes from these legacy fields. And, you know, the wells there, we estimate, probably need maintenance work at least once a year on average. So that group of wells is particularly vulnerable to these low oil prices, and we may begin to see output slide from these kind of fields starting right away even. So, so as you can see, the numbers down. By the end of 2021, we're either down a cumulative 3.7 million barrels a day, or maybe 4 million barrels a day from where we are right now. So U.S. output is really headed south in a hurry. And that, again, is a function of the activity levels that we see at these prices. So that's what I'm showing on page 7, the next slide. What are the implications for the oil service sector given this outlook for demand, inventories, prices, and production? Last year here in the U.S., we averaged a little over 940 rigs and a little over 300 frac spreads, if memory serves me correct. This year, the model we've run suggests that we'll see something like 500 rigs on average here in the U.S., down pretty hard for the next 2 quarters, only beginning to stabilize in the 4th quarter at somewhere around 300 active rigs by the Q4 of this year. So average 500 for the year. We don't really rise off that Q4 number much in 2021. And so we end up with somewhere between an average of 275 to 325 rigs working in 2021. So we're down another 35 to 45% in 21 compared to what we see happening in this year. So we're off pretty sharply for 2 full years. Frac work could be falling even faster in the near term anyway than what we see for happening for rig activity. And overall, we would guess, again, we do a quarterly survey on well costs, and we've not completed that for Q1 yet, of course, but the early word we're getting in, the anecdotal evidence suggests that, that we'll probably see well costs down on the order of 20% or so this quarter relative to the end of last year. So clearly pricing already has been affected in the oil service sector, and that's going to hit the bottom line of all these companies. So with all the attendant effects in terms of health and well-being of the companies and labor force activity and all the rest. And before I open it up for more remarks, I've got one more slide, which are just some other things that we have observed relative to the U.S. oil patch. We've spoken in the past about the lack of investor interest in the sector, and that was back in the good old days when oil prices were $50 a barrel. A couple of quotes from phone calls we've had with investors, one from Norway, one from Sweden, about we raised money in our funds, but we can't raise any more because we don't want to own anything that involves fossil fuels, basically both of us. Now, clearly, we've seen from contacts we've had with investors that in the European market anyway, there's been backing away from fossil fuels due to climate change issues and so forth, ESG concerns for the better part of 2 years, really. I think global numbers would say that something like 15% of global capital is basically being invested in with the sustainable objectives in mind, and a lot of that means no or very limited fossil fuel interest. So the sector, has suffered from a lack of access to public equity and debt markets. And and that will remain, this notion of staying out of the sector because of climate change worries is going to be with us even if when oil prices bounce back. But we are seeing some other investor funds who don't have this sustainability mandate and are more like just classic sort of bottom fishers. And they've begun to look at the oil patch and say, can we do this one more time, get in at a low point and ride it back up? So there's been some interest already from these distressed asset kinds of funds. But all that being said, operators will really, and service firms alike, will need to improve their profitability in order to attract investors in, and that's a very different type of behavior. That's going to call for a very different type of behavior than what we've seen in the past. So all my models for oil prices and rig activity and how fast spending responds to price changes, I think are sort of out the window now, because I think that the overriding concern about improved profitability is going to limit how fast operators increase CapEx and rig activity as oil prices recover. So once we get to this, post 2021 era, where markets are balanced, no spare production capacity, and oil prices we think begin to turn around and go north, I don't think that drilling activity in the U.S. will match it one for one like it has traditionally done in the past, because again, I think operators are going to be more about improved profitability rather than increasing production. And so that's going to rein in or certainly govern response that the industry has once we're sort of past this crisis. But while we're in the crisis, obviously cash management is key. Then we've not spoken yet much about small privately held independents. Many of those are very much dependent upon bank financing for their operations, and clearly the next round of bank redeterminations are going to hit this group hard, because the price deck that these banks are going to use here this spring will be much lower than the price deck that they were using to guide reserves 6 months ago. And that's going to mean that the amount that they're willing to advance these companies is going to be much lower. So that's going to, when we talk about rig activity and frac work going down, I think the publicly traded independents and the small privately held independents are both going to really suffer, really see activity suffer because of the challenges they have regarding financing. And then the last point I make is limited interest and ability in addressing technical challenges at the current time. So for the balance of this year, one of the things, again, we've always seen when prices have gone down is that's really when the industry begins to be interested in adopting new technology to find ways to find and develop reserves, produce at a lower cost. But right now, there's just no capacity to sort of respond to those kind of messages. I think you might begin to see some of that interest in trying a new way to do things. That might begin to be something that we hear about in 2021. But for the next 3 or 4 quarters, it's going to be basically the little boy at the dike trying to plug the holes that appear. So that was the last of my slides. I'm happy now to take any questions on most any topic that the audience might have. So Amy, I'll sort of pitch the ball back to you to run this for me, if you would.
All right. Instead of just opening everybody up, I'm going to ask you to just text me or, do the chat, which is over there on the right, and just say, I have a question, and I'll open you up. If nobody has questions, I'll just open everybody up, and then everybody will jump in, I'm sure. All right, I'm going to try the unmute then. We'll see, because that may be, the chat may not be something that everybody knows how to do. So let me see if I can't unmute everybody. Oh my, that's why we're not going to do that. Well, few people again. Let me just say this real quick. Does anyone have questions? All right, I'm going to say, all right, so you should hear me. Let me bring John back on. And John, can you speak now also?
Yes, I hear you. Can you hear me? Yeah, good.
I can.
So, yeah, I've had a question about aviation fuels, right? So that's probably the sector, jet fuel has probably been the sector that's been hit the most, right? The shutdown on travel internationally, domestically, and so forth has really hit that sector hard. I saw an estimate, and this is quite old now, it was a week ago, that talked about how aviation fuel demand is probably down, would fall 25%. So in context, if the world is using or was using 100 million barrels of oil a day, the aviation fuel market was somewhere around 7 to 8 million barrels per day. So 7 to 8% of the global total oil use is for jet fuel. And so you take that 7 to 8% figure and you shrink it by 25% or perhaps more, and you begin to see just how just the aviation fuel sector alone is, it contributes to the overall downturn. The other thing I believe I've heard correctly is that jet fuel doesn't store well. It doesn't. It begins to degrade from a quality standpoint. So there's real issues, I guess, about where to store it. You quickly begin to run out of storage space for these fuels, and then the fuels themselves begin to not behave properly. So I may not be the first guy on a plane once we can travel, just to make sure we're using that nice fresh jet fuel, not the old crappy stuff from February.
There you go.
Mm-hmm.
Excuse me. I do have a number of questions that have come in so far. Let's see. Matt, I'm going to unmute you. Can you hear? Matt, are you able to speak yet? Okay. So I will ask his question. How long do you think the Saudi-Russia standoff will continue?
Oh, man, oh day. Yeah, so I really don't see either party backing down at this stage. Now, what's interesting is that the Russian oil patch is not necessarily, from what I read, I don't see the Russian oil patch necessarily on board with the Russian government's desire to increase production. So I think that the April numbers that will end up coming out of Russia will show no increase in output. Part of that might be managers saying it doesn't make any sense for us to sell oil at Ural's prices of $20 a barrel. Part of it might be because the Saudis have worked really hard about taking the European market away from the Russians, and so the Russians don't have customers. So we might not see Russia's oil production go up much from where it has been, which would be very interesting. But that doesn't necessarily mean that either Russian producers or the government would then turn around and start cutting production, making nice and trying to help balance the market. So I think that both parties are looking at, we've got a lot of hundreds of $1 billion in reserves. We can stand low prices. We're going to try and wait each other out. And it might be that in each case, they're really counting on output from the U.S. going down to allow them to increase, achieve the production increases that they've said they want to see. When you begin to think about it, it is kind of unsustainable, isn't it? When OPEC Plus has been cutting production in order to defend oil prices, because you have it just then takes one decision to flood the market with oil, and so that's now what's happened. So I really just don't see much that would pull the parties together. It just then becomes a question of when do they think they've reached their goals. I spoke about how June might see the first of U.S. oil production begin to fall, but clearly would not have fallen enough then for both Russia and Saudi and UAE and the others who want to increase production, to get to the numbers that they'd like to have. So I think it's going to be a while longer. I really think this standoff will probably last for another 12 to 18 months from where we sit today. And then it might sort of just go away because U.S. output has fallen enough that everybody's producing what they wanted to, and the world goes on to the next problem, which is, gosh, I don't have enough oil for all the customers I want to have. So.
Okay. Next question I have from Neil Mendez. How much capacity does the world or U.S. have?
Ooh. Yeah. So U.S. basically produces all that it can from a crude oil standpoint. That has been right now has been 13 million barrels a day. When you add in the natural gas liquids, you get another close to 5 million barrels a day. On a global basis, the spare capacity as of the end of last year was about 2.3 million barrels a day, I think, largely in the hands of the Saudis and a couple of its friends in the world. That didn't include the sanctioned numbers from Iran. So Iran's sanctions are keeping 1.5 million-ish barrels a day off the market. And then there's always this category that is unexpectedly shut in. You have storms, you have pipeline failures, things like that sort of come and go, and that effectively keep any one moment 1 to 2 million barrels a day off the market. But there's really sort of no way to avoid those kind of figures unless you can wave a magic wand and nothing bad happens. So from a spare capacity standpoint, the industry was looking at a little over 2 million barrels a day, mostly in the hands of Saudi, and then some sanctioned numbers that were from Iran.
Okay, the next question comes from Mohan Sankrit. Are there any areas in the world that can produce oil profitably at the current prices?
Yes, an investor would like to know. So, one of the things we have to remember internationally is that the host government typically takes somewhere between 60 and 70% of the revenues from the sale of oil and gas in the form of taxes of one kind or another. So if I'm an operator in, wherever I am in the world, it's pretty typical that if I'm selling my oil for $50 a barrel, that the government tax take works out to be 60% of that. So about $30 a barrel, or maybe $35 a barrel goes to the government, and that leaves me $15 to $20 a barrel at a time when I'm selling my oil for $50, right? So, that's why you often see the field when operators talk about developing these big offshore deep water fields or wherever, that they talk about, well, we can do this at a cost of $6 a barrel or $10 a barrel or something like that. They have to because the tax take is so high. So yes, there actually are a lot of fields that can be produced at very low prices. The problem is that the government's going to take a fair amount of that cash unless the petroleum legislation that they operate under is some kind of a sliding scale, or the tax take goes to zero if prices fall below a certain point. So yeah, you can get can get some positive cash flow even at a $20 or $25 price for in some places internationally. I doubt if you can do that here in the U.S. On a sustained basis, though. Our tax take here with royalties and so forth is, generally closer to 20%, and it's 20% not as high as it is internationally because our operating costs are so much higher. So that's how we have sort of adjusted the poor quality of our reservoirs is by lowering our tax take. In places where you have great quality reservoirs, you see a much higher tax take.
All right, the next one comes from John Jeffers. For the E&P sector, with dramatically reduced capital budgets implying greatly reduced D&C activity, where do you see the focus of E&Ps on base production optimization and enhancement?
Yeah, boy, that's the thing. All these announcements that we've seen from E&P companies in the past 2 weeks about how they're cutting their capex numbers, and maybe some announcements have rig figures in there as well, frac spread activity in there as well. So they give you some guidance that say, well, over the course of the year, we see production being flat with 2019 or something off of the 2019 average. Well, it gets to be in kind of an interesting point. We've tried to go through the exercise and say, okay, well, that was our 2019 average. What was this company producing at the end of 2019? And given that they've now given us a new average number for 2020, what does that imply as to their new end of 2020 average? And we see in many cases that with these capex cuts, that operators are basically inferring that their production numbers will fall 10% or sometimes more from year-end 2019 to year-end 2020. My guess is that we'll probably see those production guidance numbers lowered as the year goes by, is my guess. So the question being, do you try and optimize your base production, or do you enhance it? I think at this point they're thinking about what's the cheapest way for me to remain an oil producer at this point. It's going to be drilling new wells, the classic approach I think that operators have always preferred, really. And so I think that's going to be what they choose to do, because given the dollars that they spend, I think they can see a better, more of an impact on their production figures than if they just try and take better care of the wells that they have right now. So I think those numbers are kind of locked in place, and it's really about where can I bring on new production most cost effectively. So I think that's going to be where they go. That will tend to benefit the Permian Basin, of course, which usually carries the lowest cost to develop. We haven't spoken much about the gas side of the business. Interestingly enough, I haven't really seen as much in the way of capex reduction coming from what are primarily gas producers as I have the oil guys. So I think the gas producers were already chopping capex last year and have gotten to a level where they can live at or expect to operate in a $2 to $2.50 gas price environment. So things haven't changed too much from them. In fact, as I look at the future strip for gas today, it's actually risen a little bit over the past couple of weeks, over the balance of this year and next. And I think that's because the market's trying to take into the fact that, well, if drilling activity falls, if oil production falls, then associated gas production is going to go down, and that portion of the market is going. And so as a result, the oversupply issue, which has bedeviled the gas sector, may ease up a little bit as time goes by. Higher oil prices have meant in the past lower gas prices. Now I think lower oil prices will result in somewhat higher gas prices. So the cutbacks we see taking place in most gas-prone areas back east and and the Haynesville and so forth are not quite as large as the cutbacks we see happening in the more oil-prone basins of the U.S.
Okay, next question. What other driving factors, items, or indicators that might impact prices should we be watching for, in addition to the excellent ones you've already mentioned? Thank you, Matt.
Yeah. What other factors are going to be key out there? Well, I think, I just sort of, mentioned in passing that none of our numbers, and I haven't seen anybody else's numbers, really talk about what happens if next, November, December, we begin to see this virus reemerge. Will the reaction in terms of lockdowns and so forth be the same? Or will we have built up enough resources in the medical sector that we keep the economy in play, keep going, and not do the shutdown that we're doing now? I think that's going to be absolute key, because everything I think I know about infectious diseases suggests that they do come back, and so we're going to have this issue to deal with again. And if that were the case, if we begin to see here in the U.S. and around the world this kind of broad, restriction in terms of moving around and so forth, then that's just another terrible blow for the sector to deal with. There won't be the best business in the world will be building stock tanks to store oil in, because we'll need about 3 billion barrels of the stuff for it. And so I think that's going to be key there, is looking at or trying to gauge the kind of improved, the enhanced capacity in the medical sector to deal with kind of the number of infections and the number of hospitalizations and so forth that we're seeing now. If we can get to the point where we can sort of handle those high surge figures, then maybe the path ahead in terms of improved economies and improved oil consumption will be clearer. But if it's not, then I think we run the risk of repeating ourselves with all this come next winter.
Goodness. The next one comes from Neil Mendez again. What actions do you feel that the Trump administration could realistically take to pressure Saudi Arabia and Russia?
Well, boy, that's a tough one. Yeah, I don't know that you can actually bully them to the table, because we have so many different objectives with regard to both those countries. The U.S. has had a pretty anti-Russian stance in many of the actions it's taken regarding Russia's involvement in Venezuela, building the pipelines, gas pipelines to Europe. We've placed sanctions on a lot of folks, and I suppose there could be some inducements toward Russia that says, listen, we'll back off some of those kind of things if you'll only agree to play nice from a supply standpoint. So it may not be threats so much as it might be carrots for the Russians. With regard to the Saudis, that's usually been a discussion the inducement side. The carrot side of discussions with Russia, with Saudis, has generally been regarding their physical security of their state, and so defense type issues. I'm not sure if that's would still work with them or not. I don't know there's many threats that we could provide to them, but at this stage. So maybe the actions that might be most effective with regard to Russia's status. But like I said, it's interesting that the Russian oil sector hasn't opened up the valves and started pumping just because the federal government there has said they want to increase output. So So the sense you get is that there's a little bit more independent action on the part of the Russian oil industry. And that being the case, it might not be very effective for the Russians to sort of abandon what might effectively be a very sort of paper threat to increase output.
Okay.
Mm-hmm.
We have a follow-up question on your jet fuel discussion earlier. Can jet fuel be converted to something else?
That's a very good question. I have no idea. I have no idea if that's a possibility at this stage. To be blended or something like that. We all might find that our cars go a little bit faster, I suppose, if that were the case. But I really don't have an answer there.
There may be someone on the call that's downstream that has an answer. If you do, I can open yours up. So the next one comes from Richard Martinez also. I've heard that Texas was invited to the June OPEC meeting. Is this true?
Oh, I think there's been discussions about that. And I'm not sure what the response has been other than to sort of take the call. There's no doubt a host of challenges that if they showed up, what could they actually do, right? And like I said, they might just show up and say, listen, we've already seen production fall 2 or 3% since March, so we're doing our part. So I don't know that, the thought is that would Texas, like the old Interstate Oil Compact Commission, come together with the other producing states here in the U.S. and begin to ration production and as a result hold oil off the market like was seen back in the 30s when there was way too much oil for that depression. So that's been bandied about, but I'm not sure at the end of the day that that's a right thing to do. And then, of course, you'd have to run that past a bunch of investors whose oil managements have promised production gains or whatnot. And so this would it's not like there may be parties that would think something like pro-rationing would solve problems, but I'm not sure that we get a lot of buy-in across the board. So I don't think that's I don't give that much of a chance of happening, I guess.
We actually have Blake Eskew that will speak to the jet fuel question. I think you're open.
Yeah, I'm open here. Yeah, in general, most jet can be blended to diesel, depending on the flash point of the jet and the specific product specs. It happens every winter, when that's how you make winter diesel out of summer diesel is you blend the lighter components in it to make it bring the coal properties improved. So it's not true that every batch of jet can just be dumped into diesel, but most of it can go back into the diesel pool.
Now I know. Thank you.
Thank you, Blake.
Mm-hmm.
Okay, so we have another question. Rick Massey, what happens to U.S. oil and gas exports with low prices? Yeah, so exports had been running 4 million barrels a day last time I looked, and our forecast of production, declines would suggest that by the end of next year we'll be down about 4 million barrels a day. So, but again, the challenge has been, we've exported a lot of our most of the exports have been light sweet crude because they've not found a home in U.S. refineries that are more set up for heavy sour grades, right? So I think that as U.S. crude production falls, that we'll see an attendant decrease in our oil exports as a result of that. The one complicating factor might be, if I remember correctly, in the good old days of about 2 months ago, a U.S.-China trade agreement called for us to sell
million barrels a day of crude to China, if I remember correctly. I think the Chinese committed to that, those kind of purchase numbers. And so that might get to be a very difficult thing to achieve in 2 years' time. So, but generally speaking, I think that because of the nature of the oil, the grades that we're producing, that exports will go lower in a hurry.
Okay, I have another one coming in. You mentioned that well costs are expected to be down 20% this quarter versus last year. Do you think service providers have the ability to grant this level of price concessions?
Yeah, that's a very good question. Actually, we've heard that some have voluntarily offered 15 to 20% discounts. So I think that's I think we're to the stage where, they're looking at the type of activity drop that we've been talking about and have said that they're scratching to keep their organization intact to some degree, and so they're willing to work below cash profit numbers for sure. So this is going to be a real challenge because I think we're going to see a lot of fine businesses on the service sector exit the industry. There's just too much capacity, not enough work to go around. And as that happens, pricing gets pretty goofy. We saw that back in the 2015-16 period. So I think we think of it in terms of an index of cost. And we drop 20% from today's level, that basically puts us sort of back at the same low cost points we saw in the worst days of 2019. So in between, businesses have gotten more efficient, leaner, and so forth, lower overheads, but still it's to a point where there just won't be enough work for companies to go around. So you're just trying to outlast the other guy at this stage, I think.
On that same note, what are your thoughts on consolidation?
Well, the problem is going to be the bid-ask spread that you've got. You've got companies that might be interested in consolidating. The question will be, will the sellers, want too much for their company? And so that's the other thing that happens at a time like this. It's really a challenge for firms to reach agreement on what the value of an enterprise is. And so a lot of times what we see is that just nothing happens. And I think that will probably be what we see most of this year, is that while there'll be a lot of companies that might benefit, or industry segments that might benefit from consolidation, that gap between what the buyer would pay and what the seller wants to get is just too wide to see the deal happen. And so it just becomes a question of sort of, how long can you hold on in a situation like that? And to the extent you've got buyers, they may be outside the industry buyers. I'm not sure that you'll necessarily find companies within the market and oil field service firms that are here today being buyers. They may be companies that are outside the industry who are trying to take advantage of the situation to establish a presence.
So you think that companies will have to go all the way bankrupt before some of that will happen, where they would just buy the pieces?
I think so, yeah. We did a study a very long time ago, back in the 80s. The question at the time was I think the question was about cased hole wireline units. It was very interesting. Our sponsor asked how many cased hole wireline companies were there at the peak of the market. That would have been in 81, 82. And how many were there then in 86 or 87? And so we went back and managed to sort of recover as much history as we could. And I think the numbers were roughly that there were about 500 cased hole wireline companies in the U.S. in 81. Now you have to remember, we were running over 4,000 drilling rigs, right? So we were drilling 100,000 wells. So numbers sound crazy, but we had a lot of activity. 5 years later, the industry had crashed. We were now drilling 20,000 wells, something like that, and yet there were still about 500 caseflow wireline companies. The industry, the equipment had never gone away. It had been sold at auction for pennies on the dollar, and someone had found a buyer, and they'd gone back to work. So now they were capitalized at a much lower figure, and yet the capacity of the industry was not much changed. And over even though activity was down by by 3 or 4 fold, or activity was 25% of what it had been. So this kind of thing is what happens. We've got a lot of long-term capital equipment, and it doesn't exit the industry easily. And so we end up recapitalizing new companies that enter at very low cost.
I will say it's pretty sad that you referred back to something from the 1980s that could be rehashed.
Yeah. Curse of a memory. Yeah.
So I don't have any more questions. Are there any other questions that need to be asked? Anyone have any Anyone have any comments that they want to show? And I'm afraid to just open everybody up, but well, I want to. Great job, John. Thank you for your time. I heard that from Matt King. I want to thank everybody for attending. It wasn't ideal. We would rather have dessert and be meeting here at the Federal Reserve Bank here in Houston. But if anyone is in Houston and would like to come to our meetings when we have them again, they are on Thursdays during the school year. And so we will be putting those back. We also we have scheduled some WebEx. One's already set up for May, and I believe we are negotiating with someone for April. So I really appreciate you all doing that. We will at least be putting the presentation on the USAEE.org Houston chapter site. If the recording works and I am able to do that, we will also put that out there. John, we really appreciate your thoughts and your questions that you asked and answered. So thank you so much for this time, and everybody, please stay safe.
It was a lot of fun. Thanks so much for the invitation. I hope that you do it again soon.
John, don't ask that. We'll ask you to. Thanks so much.
Thank you. Bye-bye.
Bye-bye.